There seems to be a lot of confusion about this concept of the Fed tapering, and there was confusion the last time that it came up when Bernanke was the Fed chair. So the Fed has been buying $120 billion worth of bonds every month for almost 18 months. And so 80 billion of those are treasuries and 40 billion are mortgage-backed securities. So the U.S. government we're in a deficit each year in terms of our spending, what's going out versus what's coming in. The way that we fund that is by issuing treasury bonds and bills and notes. And there has to be somebody to buy them in order to fund our government's operation. So if there's not enough appetite out there from insurance companies and banks and foreign governments and individuals, then the Fed is kind of making up the difference. That's the idea behind quantitative easing. And what they're saying with this announcement that they're going to start tapering is that they don't need to fill that gap anymore for one reason or another. And they're not saying exactly why that is, and they don't need to. They're signaling that the economy is stronger and or that there is enough appetite for our government's notes that they don't need to be doing as much as they're doing. Yeah, it's funny how people love to hate the Federal Reserve because it's sort of this big bad agency that operates behind closed doors, and they kind of pulling strings and people don't quite understand what's going on. And I don't personally believe that the Fed is wrong about inflation being transitory. I believe that it most likely is transitory. That's my personal opinion though, and I may be proven wrong. Obviously, the Fed would be proven wrong in that case too. I think that it's just too early to determine that some of these price increases are going to stay around long term. Yes, and I think even the Fed is acknowledging that prices have gone up. We saw a CPI print that was really high yesterday, and housing prices are up, cost of food is up, cost of gas at the pump is up. Prices are up. Nobody's denying that. The question mark remains how much of that is going to revert downwards, or at the very least prices maybe will stop rising at some point in the not too distant future. How much of this is because of the supply chain disruption that we've seen as a result of COVID? I don't think the oil and gas issue has anything to do with that. I think that has to do with years of underinvestment in that space. So that's likely to stay somewhat elevated in my opinion. But people that get nervous about that need to, I think, maybe look back only 10 years ago. Between 2010 and 2014, oil was over $100 a barrel for all 4 of those years, and nobody was talking about inflation. Right now it's at about $80 a barrel. So we're actually below that level in terms of energy and input costs. So I don't know that we have data that suggests that all of this other inflation is likely to continue. I think it's really early still. Even though this topic has been going on for about 6 months, I think it's really early to blame a Fed mistake for rising prices across the board. I think there's a bunch of things you can point to say that the Fed is not wrong. You can point to the largest and most liquid market in the world, which is U.S. Treasuries, and interest rates have barely budged. So the world, or the largest market in the world, is telling you that inflation expectations are perfectly aligned and that the Fed is not doing anything wrong. Great question. Nobody's asking that question. Everybody is just totally black and white when it comes to renewables/alternatives versus fossil fuels. There's no sensible, reasonable conversation happening about the fact that at the moment and for the foreseeable future, we need both. We need both, because the overwhelming majority of the world's energy demand is supplied or met by fossil fuels at the moment. And we've done a good job as a whole reducing consumption of coal. Coal is the worst or the dirtiest. We've replaced a lot of that demand with natural gas, which is much cleaner. Oil is still a huge component to meeting the world's energy needs. Alternatives are really, really small. They're growing really fast, but they're really, really small. So the question is, can they coexist? The answer is that they have to for probably a long time. And I mean, if the world's energy needs are growing exponentially over the next multiple decades, I don't think most people can fathom how fast renewables have to grow and also become less expensive in order for them to keep getting the market share in relative terms over the next several decades. It's too expensive for mass adoption in emerging markets. So it just doesn't really solve their problem at all. If I'm India, for example, and my goal is really to feed our people and to employ and feed our people, I'm just not concerned about how clean I'm doing that. I can't afford to be. As is always the case, there's a laundry list of things that could go wrong and things that are top of mind for investors. So the stock market being at all-time highs is, to me, not concerning, but it's something that gets headlines. And for whatever reason, people hear that we're at an all-time high and they just assume that that indicates that there's a crash or a correction right around the corner. It's not sustainable. How can the market be at an all-time high, especially given all these negative headlines that we're seeing? Again, we've mentioned this on previous videos, the market is at an all-time high something like 84 or 85% of the time. It's just when something goes up high single digits on average for 100 years, that's just mathematically what ends up happening. So that's not scary on its own. The movement in interest rates is not scary right now. And that's with the Fed having announced tapering, announced how much tapering they're going to do and when they're going to do it. So the Fed is saying we're going to be taking we're going to be reducing the pressure on the gas pedal slightly. And the market has so far responded favorably, I would say. The labor shortage is an issue that I think will correct itself in time. Two ways. One, we've seen that wages have started to increase, to improve. Employers are responding to the fact that they need people to fill these jobs. There's a healthy medium of how much employers need to raise the wages, and then at some point I think we're going to see, as the stimulus leaves the system, and we've already seen unemployment benefits that's in the rear view. So at some point I think maybe workers need to accept maybe slightly lower wages than they're hoping for, not necessarily lower than they deserve or lower than they used to get, but lower than they were hoping for. And I think maybe some of these jobs will fill. And the unemployment rate has come down dramatically from where it was a year ago. So the trend is still positive. But the question about the speculative mania that's in these sort of related asset classes, the crypto and the NFTs and these meme stocks, which I can't believe we're still talking about meme stocks. That's probably the most concerning of all of them to me, just because of what it represents. It's like people are bored of the returns they can get in the stock market, which to me seems completely insane given the last 2 years. We've had way above average returns in the stock market the last 2 years, and people are still saying that's not enough. I need more excitement. I need an opportunity to double my money overnight.
Well, I think they're comparing that to cryptocurrencies, and I think that's what you're seeing. You're seeing, people talk to their friends. Oh, I bought Bitcoin at 10,000. It's at 60,000. I think that it's people. Some investors, I think younger investors, are struggling to buy stocks because they're watching these speculative assets go up.
And that question alone brings up, I suppose, an answer to the question of what could go right. If these are younger investors who maybe don't have a lot of money in the market, then this speculative bubble, in theory, could burst without affecting the stock market because there's not enough overlap. It's not like somebody who owns $50 million worth of bonds and $50 million worth of stocks, and one loses so much in value very, very quickly that they need to sell the other. And that impacts, there's sort of this snowball effect. If it's true that there's not much overlap between who's involved in these speculative bubbles and the traditional investments, then that's something that could go right if everything were to go wrong as far as the speculative assets. So, I think all signs really kind of point towards slow and steady from here. I think it's unreasonable to expect huge forward returns in the stock market from this point. I think, we could maybe get positive returns between here and the end of the year, but we've definitely squeezed a lot of the juice out of this particular piece of fruit.